The Plug Power stock, trading under the ticker PLUG, currently stands at $2.62, showing an intraday movement that's struggling to find firm direction after a recent dip, despite opening higher. This minor volatility today follows a more significant downward trend over the past week, where the stock gave back some of the impressive gains it had seen leading up to its recent operational announcements. The initial market expectation around Plug Power has always been simple. Hydrogen is the future of large-scale industrial and material handling power, and Plug, as an early mover, is positioned to capture it all. The reality, however, that the market often overlooks is the intensely technical and financial hurdle that separates concept from consistent, profitable execution in the green hydrogen space. The current price action, marked by high daily trading volumes suggesting strong short-term conviction from both buyers and sellers, around 87 million shares recently, is a direct reflection of this tension between long-term vision and immediate fiscal reality. While many investors are just focusing on the next quarter's earnings report, which is rapidly approaching and will be critical, the real and unexpected story is the quiet, methodical international expansion that's actually generating contracted value, even as the company's domestic profitability remains a distant target. The common belief about Plug Power is that it's a high-growth, high-risk speculation on the future of clean energy, heavily dependent on government subsidies and the eventual scaling of the hydrogen economy. This narrative is absolutely true, but it misses a crucial, counterintuitive detail. The company's recent strategic focus on becoming a vertically integrated hydrogen producer is a desperate measure that is simultaneously its biggest gamble and its best chance for long-term stability. Traditionally, Plug focused on selling fuel cell systems, such as those used by massive customers like Amazon and Walmart for material handling equipment. This business model relies on buying liquid hydrogen from third parties, and it's been bleeding cash because the cost of sourcing that hydrogen has consistently eaten away at their gross margins, often pushing them into negative gross territory. The unexpected twist is that their solution, building their own hydrogen production plants and a distribution network, is an enormously capital-intensive move for a company that is already deeply unprofitable, but it's the only way to gain cost control and stabilize their unit economics in the future. They are essentially trading high capital expenditure and near-term losses for the prospect of structurally improved margins down the line. This operational shift fundamentally changes the investment thesis from a pure technology play to an infrastructure and commodity play, which is a much slower, lumpier business with different financial needs. Looking closer at the recent stock movement, the dramatic swings are characteristic of a low-price stock with a high beta, currently sitting around 2.28, which means it's highly sensitive to broader market sentiment and sector news, especially for highly watched stocks like Tesla stock and Nvidia stock, which often set the tone for speculative tech. The recent pullback, despite some positive operational news, like the start of a 5-megawatt electrolyzer installation for the H2 Hollandia project in the Netherlands, and a significant 2-gigawatt electrolyzer deal with Allied Biofuels, underscores the market's current focus on financial stability over contracted capacity. Investors are right to be nervous about the company's financial metrics. The price-to-earnings ratio is deeply negative, and the company has been consistently reporting large net losses, with the last reported quarterly EPS coming in at a miss compared to analyst consensus, even though revenue beat expectations. The market is effectively discounting future capacity and contracts because of the persistent high cash burn. The company is simply burning through capital faster than it can convert its promising pipeline into actual free cash flow. This is where the tension between expectation and reality is most acute. The expectation is that a large deal means immediate stock appreciation. The reality is that the market demands a clear path to positive gross margins and free cash flow before it rewards those deals sustainably. Institutional activity shows a mixed picture, which only adds to the volatility. While the total number of institutional owners remains high, suggesting conviction from large players like Vanguard and BlackRock, who appreciate the long-term thematic importance of green energy. There's also been an overall decrease in the average portfolio allocation to Plug, and more institutions decreasing positions in the most recently reported quarter. This suggests some institutional fatigue or a tactical reduction in risk ahead of the crucial Q3 earnings report, which is a common pattern for speculative stocks like this. The analyst community is similarly divided, with a consensus rating of hold and a wide price target range, running from a low of $0.75 to a high of $7. This massive spread tells you that even the professionals can't agree on the fundamental value because the ultimate success of the hydrogen market itself, as well as Plug Power's place in it, is still a major variable. The optimists, like the analyst who set a $7 price target, are clearly valuing the pipeline of contracts and the potential for federal subsidies to accelerate the timeline to profitability. The pessimists are simply looking at the balance sheet, the debt-to-equity ratio, and the continuous cash burn, and concluding that the need for future capital raises and potential shareholder dilution is too great a risk right now. The core of what Plug Power does centers on the production and deployment of proton exchange membrane fuel cell systems and the associated hydrogen infrastructure. They are at heart trying to facilitate the broader commercial adoption of hydrogen. Their GenDrive fuel cell systems replace traditional lead-acid batteries in electric forklifts, a market where they have major penetration with industrial leaders. The value proposition here is faster refueling times, consistent power output, and reduced space requirements compared to massive battery charging areas. But their future growth is heavily pinned on the expansion beyond material handling into stationary power, on-road electric vehicles, and, most importantly, the construction of their own green hydrogen network. This ecosystem approach, covering hydrogen production, liquefaction, storage, delivery, and end-use fuel cell systems, is intended to de-risk the supply chain and reduce the dependency on external hydrogen suppliers who may charge prohibitive prices. Their older reports confirm a long history of losing money, a common feature among companies building out entirely new energy infrastructure. Past performance shows massive swings, often following political developments, such as tax credit legislation, rather than steady operational improvement, which makes it a difficult stock for any kind of methodical approach to investing, like what you would find with Schwab Intelligent Portfolios or using a managed Fidelity wealth management account. Investing in PLG is less about predictable growth and more about wagering on a secular, high-risk, high-reward theme. The future outlook for Plug Power hinges almost entirely on two immediate factors: the upcoming Q3 earnings report and the continued execution of their hydrogen plant build-out. If the Q3 report, scheduled for release soon, shows any signs of improvement in their gross margins, even a small step closer to the break-even point they have targeted, it could provide the relief the stock needs to retest its recent high. The market is hypersensitive to any news regarding cost of goods sold and operating expenses. Success here means that the narrative of vertical integration is starting to pay off, bridging the chasm between expectation, high growth potential, and reality, negative profitability. Conversely, another large margin miss will likely trigger a wave of selling, especially given the current nervousness in volatile speculative sectors. Another major catalyst is the status of government funding, especially the specifics around hydrogen production tax credits that are meant to stabilize the economics of green hydrogen. The quicker and clearer this regulatory landscape becomes, the faster Plug Power can de-risk its capital plan and secure the necessary project financing to complete its network of green hydrogen plants. This is the macro factor that could provide the biggest boost, as it changes the underlying economic equation for every kilogram of hydrogen they produce. It would be a significant validation for proponents of self-investing who have kept the faith. The risks remain enormous. Liquidity is a constant concern for a company burning cash at this rate, which means the threat of future capital raises and stock dilution is ever present. Dilution is always a headwind for the stock price because it means the future pie of profits will be split among more shares. The competition is also intensifying, as large industrial gas companies and other fuel cell providers like Bloom Energy move aggressively into the green hydrogen space. Plug Power must rapidly transition from being a technology provider to a low-cost, high-volume producer and distributor to maintain its market position. The investment is effectively a high-stakes long-term options play on the future commodity price of green hydrogen and the company's ability to successfully control its production costs. For those utilizing platforms for online investment, like the Robinhood app or the robust tools of the Interactive Brokers platform, which allow easy access to highly volatile shares, the risk management here is paramount. This is certainly not a stock one would typically place in a low-risk Schwab Intelligent portfolio.